Hello everybody and welcome to another video on financial analysis, and today we are going to be looking at McBride. So let's jump in and see what they do. So McBride is a leading British-based manufacturing business, known as being Europe's biggest maker of retailer own brand household goods. So if you think about it, if you're going to go into a lot of these shops and you buy kind of well-known brands, and if you buy the brand of the shop that you are actually in, typically these are the guys who are actually making it. So it's low margin business, very, very competitive. So financial analysis, we are going to be looking through their financial accounts behind the the numbers behind the business, and trying to give you a kind of a flavor and also teach you how to read and interpret that financial information. So maybe you're watching this because you're a potential investor, maybe you want to buy shares in McBride, maybe you want to go short on shares in McBride, maybe you're just looking to understand and be able to read financial information, maybe you're looking to join them as an employee, maybe you are thinking about supplying to them, maybe you are thinking of buying from them. So whatever your position, hopefully this is going to provide you with some additional information. Now, welcome if you are first time to this channel. If you're coming back, if you're a subscriber, welcome back. And if you are not a subscriber, please do click on the subscribe button. Don't forget to like and share. And if you are a subscriber, it means that you can post requests in the comments box, and this is actually a request from a chap called Seb Jacobs, who said, thanks for looking at this one. That was reference to another video, I forget which one it was, but he says, great to get another perspective on their financials. Would you consider looking at McBride? Now, he says they've got about a 40 million market cap, it's actually 45 million today, and are effectively priced for bankruptcy. It would be good to great to get your thoughts. So for Seb Jacobs and anybody else interested in McBride, here we go. So let's dive in and have a look at their financial statements. Here is their financial statements. It's available on their website. Now we're looking at the 2022 financial statements, so a little bit out of date. Probably worth having a look at the yearly report, which is also on their website. We'll have a look at that a little bit later on, but these are the annual report and accounts which we are going to be having a look through. In the annual report and accounts, give you lots of information about the company, who they are, what they do, and who the directors are, their pedigree, etc., etc., etc. But we are going to whiz through all of that, and if you are interested in understanding the company, then it is worth reading that. Obviously, this is marketing material. Bear that in mind. There'll be a positive spin on it. But if we whiz all the way through that, we come down to their financial statements, and this is where we are really interested in our financial analysis. So here we are. We've got the consolidated income statement, which is on page 146 of a total of 216. So here is the financial statements, the consolidated income statement. Let's see what it's telling us. So first up, what do we see? The revenue, 678 million pounds. We're in millions of pounds. There it is, millions. A little bit down on the previous year, so about 1% fall on 2021. Now you'll notice they've got a couple of columns here. They kind of talk about adjusted and adjusting, and quite frankly, you often get kind of one-off and special, and it's not going to happen again, and they happen every single year. So let's really just focus our efforts on this total column. They talk about this operating profit. It's actually a loss for them, and they've done that after these two numbers here. Now loss or gain on disposal of property, plant and equipment isn't really part of their operating activities, so I would tend to take that out. And also the impairment of property, plant and equipment, that's kind of one-off, right down in the value of equipment rather than depreciation. So I'm going to take that off. So I would typically take those numbers and kind of put them below the line, so to speak, given that this is the line here. I put them below the line, and really I think they got an operating loss of 29 million pounds if you exclude those couple of items. That's about a 4% operating loss. Equivalent last year, a 2% operating profit. Okay, so their gross profit here, 191 million on sales of 670, is about a 28% margin. That means for every a household product their clients buy, it's costing these guys 72 to manufacture it, and they get to keep 28p in the pound. Now that's pretty low margin. You may be thinking that sounds pretty good, but that's a pretty low margin, especially if they're carrying all of these overheads and administrative costs and all of these distribution costs. So they're basically, previous year they were running at pretty much break even, and this year they've actually made a loss on that. Okay, so this company is now making a loss. The margin has fallen. The margin last year, the gross margin last year was 35%. It's now 28%. They're getting squeezed in their margins. Either that's the cost of the inputs is going up, quite possibly with the kind of the world of inflation that we're in, or the revenue's being squeezed down. Don't forget, a lot of these will be multiples. There'll be Sainsbury's kind of, floor cleaner, for example. And, those guys are they're just going to push those prices right down. So these guys are getting really squeezed in the middle. And that's basically driving this loss of 24 million. So it's not a massive loss, but it's a loss. It's certainly the wrong side. 14 million is basically, that's break even. That's a kind of a 2% net margin. So these guys not looking too good, and serious headwinds to come. Let's have a look at their balance sheet, see what's going on in their balance sheet. So here we can see the non-current assets, things they need to run the business, mainly made up of property, plant and equipment, little bit of assets on hire purchase. Surprisingly, quite a low amount there. So this is going to be really their kind of manufacturing equipment, and that's basically a little bit of goodwill, suggesting that they've bought a couple of other companies, but mainly organic growth. And the PPE is the big number there. Current assets, well, they've got quite a lot of inventory. There's quite a lot of inventory, and they've also got a lot of trade and other receivables. Now, remember, these guys are dealing with multiples. They're dealing with the Sainsbury's and the Tesco's, and they are not very good at paying. So this is going to squeeze their cash flow. So they've got a lot of inventory, and then a lot of money by their customers, and that means that they don't have a lot of cash sitting in the bank. Okay, so they're making a loss, and it looks to me like this is straining their cash flow, and I'd be surprised if they have positive cash flow. We'll find out in a minute. There you can see just at the bottom of the screen is their current liabilities, the trade and other payables. That is what they owe to their suppliers. Now, of course, if these guys don't get paid, then they're going to struggle to pay their suppliers, and of course, if their suppliers start to lose faith, their suppliers will stop supplying, and the whole thing comes crashing down like a house of cards. So really important that these guys can maintain that liquidity. Many of you will be familiar with the liquidity, the current ratio, where we compare the current assets with the current liability. Remember, current assets, things we own, which are either cash or going to become cash soon. That's 273 million pounds. And current liabilities, things we owe and have to pay soon, 280 million pounds. So that is not a good ratio. That says for every £1 I owe and have to pay soon, I've got either 98p, either as cash or coming in as cash soon. Okay, that's not good. And if you then eliminate the inventory, this is the acid test, and do the same comparison, it's for every £1 I owe and have to pay soon, I've got 55p, either as cash or coming in as cash soon, ignoring the inventory. Okay, so these guys have major liquidity. It looks to me like they have significant liquidity problems. Now, that ratio isn't a problem if you're very, very cash generative. I don't think these guys are cash generative. Let's just carry on through the rest of the balance sheet before we get to cash flow, though. Worth noting, debt. They are carrying debt. Look, and that debt has increased. Okay, so the short-term debt hasn't, but they're gonna have to refinance this 60 million. They're gonna have to, they've only got 4.5 million quid in the bank, so they're gonna have to go to the banks and they're gonna have to refinance. Either that, or they're gonna have to go to the shareholders and say, we need some equity in order to be able to pay down the debt. That's what's known as an equity for debt swap. Or they're going to have to go to the banks, and the banks are going to look at these guys and say, well, can you afford the debt? So the banks are going to look at their income statement. This is kind of very back of an envelope calculation, but they're going to basically say, look, the debt is costing you £8.6 million a year in interest, and you're making a loss of 26 million pounds. Am I going to lend money to you? And you can kind of start to see, this is going to be a fairly difficult conversation that these guys are going to be having. In terms of the equity, they're sitting on accumulated losses. So these guys have been making losses. They have a history of making losses. I don't know their kind of, their long-term past, but the equity is in there. They've raised the equity, but they are sitting on losses, and are they going to make a profit? Are they going to turn the corner? Who knows? Here's their cash flow statement. The key number in the cash flow statement is looking at their cash used in operating activities. They're burning cash, so they've made a loss of 30 million in cash, small profit the previous year. Okay, now this is a really important number. If you've got 4.5 million quid in the bank and you're burning 30 million a year, essentially, if you can't get any more financing, then that is it. So these guys are really dependent on either turning the corner or being able to persuade financiers, whether that's the banks or the shareholders, to actually back them. So fairly significant. You can see up here, there's the loss from continuing operations, for example. So not good, and we see here decrease in receivables, so that they're collecting money in. Decrease in inventories. Sorry, that's an increase in inventories, increase in receivables. Both of those are having negative effects on their cash flow, and therefore increase in payables. An increase in payables. Well, if you're growing a business, then you'd expect your increase in payables to go up. But if you're not, then it just means that these guys are using their suppliers to finance them. So back of an envelope calculation, and I do emphasize this is back of an envelope calculation, suggests to me that it takes them about 80 days to sell the inventory. From the time they buy their raw material, turn it into the finished goods and actually sell it, takes them 80 days, quite a long time. Takes them another 63 days to collect the money in. I think it's EU Directive 711 says that you're not allowed to pay your suppliers more than 60 days. So people like Tesco and Sainsbury's will take them right up to the wire and pay them as late as possible. And that means that these guys, they're really struggling on cash. They're not paying their suppliers for 103 days. Okay. Now, those are approximate numbers, but so if you're looking to supply these guys, you're gonna have to sit down and get your negotiation boots out and really keep an eye on those payment terms, because otherwise you ain't going to get paid for a good 3 or 4 months from the moment that you actually supply the goods or services. So some fairly some straining numbers, let's say, kind of, and they are struggling. I mean, this is not all that good. If we actually have a look at the the auditor's report, always worth just having a look at what else is in the account. So the auditor's report is on page 139. Here it is, talks about statement of directors' responsibilities, etc., and then we get to the auditor's report, and it talks about this material uncertainty relating to going concern. Okay, and so the auditors are basically saying, look, these guys are struggling. They've done lots of scenarios. I'll leave you to read the kind of the document. It goes on for quite a long while, but it does say you kind of need to have a look at note 2. Because that's what the directors have said. So the auditors are saying, look, we've signed off the accounts. It is a going concern, but we just want you to be aware that this company is, it's closer to the cliff edge than we would feel comfortable. And the directors recognize that. They've noted it in note 2. So we can have a look at note 2. Note 2 is actually on page 152. So if we whiz down to page 152, here we go. And we can see here on the left-hand side, going concern. There's a long note from the directors in the notes to the account that says that, we have prepared it on a going concern basis. Now, worth bearing in mind, you're not allowed to trade if you are no longer a going concern. Okay, so it is illegal for the directors to trade if they are no longer a going concern. But and by going concern, I mean, you're not trading and expected to be able to trade for the foreseeable future, i.e. they can't enter into contracts knowing they can't pay those contracts. However, when a company goes bust, it's a kind of, it's not always a sort of a very clearly defined moment, and usually a company goes bust when it can't pay its staff, because if you don't pay your staff this year, this month, then they won't turn up to work next month, and the business effectively ceases. And if you don't pay your suppliers, they stop supplying you, the business effectively ceases. So those really kind of the pinch points: pay your suppliers, pay your staff, and these guys are struggling. So we go back to their cash flow. Just want to finish off that cash flow statement. If we can find the cash flow, here it is. So for the cash flow, we saw the loss. They are doing some investing in the future of the business, not a huge amount of investing, and you'll notice that the investment is, it's about the same as the depreciation. So the investment and the depreciation, roughly the same. But you can see certainly in the financing, these guys are effectively being kept alive through bank loans. Okay, so here is the increase in the bank loans. Over here we've got, this is basically refinancing. So they're kind of, there's refinancing positives and negatives, but in our in the 2022 numbers, they've got cash coming in, and the cash coming in is due to these bank loans, and that is basically keeping them alive just, and they've got £4.5 million in the bank, which is not enough. And this note, as we say, it talks a lot about the reasons that they believe, so it says here, for example, that directors are considered severe but plausible downside scenarios, and etc., and we kind of, and we're all reasonably comfortable that we can, and we may have to sort of, increase liquidity by 25 million. Invoice discounting, for example. So that's kind of where they'll sell something to Sainsbury's and send this invoice to Sainsbury's, and then get a bank to pay them today, and then Sainsbury's pay the bank a little bit later on, and they take a small hit in the middle there. So there's lots of kind of ways that they can kind of get themselves out of this. But they recognize that this is a challenge. Let's put it like that. This is a challenge for them. So I guess the question is then, how is that reflected in their financial, in their share price? So let's go and have a look at their share price and see what that's been doing. And it has been bouncing around a lot and is now at 26. So it is pretty low in terms of the share price. Market cap is 45 million. Just to kind of put that into context, the balance sheet is remember the balance sheet. So the net asset value of this business is 57 million. So in theory, if you close the business down, if you buy it for 45 million and close it down, you're going to get 57 million of net assets. Now that's a theoretical number already, but so basically it's trading at below book value. But there's a reason it's trading at below book value, is that it's making a loss, it's burning cash, it's suffering from these squeeze of expenses, that its customers are very, very hard negotiators and will hammer them on price. They are suffering from the cost of inputs going up, and life is challenging for them, and they've taken on more debt, and I'm not sure that they can necessarily afford that debt, and interest rates are going up, and that's going to cause them even more misery in the future. So I think yes, these guys are priced for bankruptcy, and you can start to see why. Are they, would you expect to, I can't see the kind of, I can't see them sort of, bouncing back up to this kind of a height. I can't see it, necessarily going up here. Don't forget, anything, doesn't matter how cheap it is, it can always go to zero, but it might not. So, a lot of bad news reflected in the price. Not sure it's necessarily, a great opportunity either for a short or for a buy. So I did promise you a quick look at the half-year results. So here we are. These are the half-year results out reasonably, a couple of months ago. So 31st of December. Revenue looks like it's up on the equivalent of the previous year. Still making a loss though. Still making a loss. So and the loss is widening. So they haven't managed to solve their loss making. Looking at the balance sheet, have a quick look at the balance sheet. There's not going to be a huge amount of difference, but we might just have a look at the borrowings. Borrowings down a little bit on the previous year, but borrowings, look at that, it's rising. So the borrowings are going up. So it looks to me like they're funding, and they still got, they've only got 8 million in cash in the bank. So there's the 4.5 million they had at the end of the year, and there's only got 8 million, and it's all tied up in trade and other receivables and inventories. And you can start to see that their trade payables are starting to tick up further as well. So not going in the right direction there. Look at the cash flow. Positive cash flow, so that's got to be a good thing. Positive cash flow. Let's just have a look at that number in a bit more detail. What's driving this? Well, decrease in receivables. Okay, so that number there, the decrease in receivables, is driving as a big driver of the of that positive cash flow. But however, look at this, finance costs. Okay, this is the cost of the debt. The finance cost is going up because there are higher risk and interest rates are going up, so the debt is becoming more expensive. We are going to see that in the income statement. Whiz back to the income statement and we can see there's the finance cost. Look at that, that's a really big number. That's driving most of that loss. So these guys, they just got too much debt, and they can't afford that debt. The debt is really expensive. And look at what's going on here in the financing, drawdown of bank loans, okay, repayment of bank loans, refinancing costs paid. You know, this is, you know, their debt is still increasing. That debt is becoming more expensive. You know, they're not out of the woodwork by any means. They're still digging themselves further and further into the hole. You know, can they get out of that hole? Well, you know, there's the $1 million question, isn't it? So the balance sheet right now, let's just look at the equity in the balance sheet. So there's the equity, it's 37 million pounds. The market cap is, I think we're talking about 45 million pounds, which means that if you buy this company, you should theoretically be able to sell all of the assets, pay off the liabilities, and end up with 37 million pounds. So these guys are, you know, the equity has fallen now. It's you know, they're trading above their book value. There was their book value at the end of the year. Now they've traded their book value has actually fallen because of those losses. The share price, you know, is still, you know, it's slightly above that. So there's a little bit of goodwill in there. So there we go. There is our McBride. I hope you found that useful and interesting. Personally, I'm not an investor in McBride, and quite interestingly enough, and I'll just show you this as a kind of as a final aside, which I thought was, you know, quite interesting, is if we look at the directors. I was sniffing around. In fact, we always like to have a look at the directors' remuneration. So let's just do that while we're here. So directors' remuneration, you'll find the directors' remuneration on page 123. Here is page 123. And you can see that it's Chris Smith who's in charge. There he is, and he's on £551,000, so about £500,000. Okay, you know, nowhere near some of the sort of sizes that I've seen for other CEOs. And interesting enough, looking at their kind of their shareholding, it says that all of the directors are holding too few shares. That the number of shares they own is below guideline. Now, you can read into that what you want. I'm not going to say anything, but you know, I can see why. You know, if I was a director of this business, I wouldn't want to have all my eggs in the same basket. Let's just put it like that. And then if we want to see the employees, that's on page 152. Here it is. So we go down to 100. No, it's not. I'm sorry. It's on page 167. So page 167 has the employees. Here it is. And we can see that there are a total, so this is the total average number of employees, about 3,000 employees, and they're paid a total of about £126 million, which is an average pay of £42,678 per person. So if you're an employee of McBride, you can now work out whether you're above average or below average. There's a slight increase on last year, so an average of a 2% pay rise on 41,000, and so the CEO is paid about 13 times times the average salary, which does not appear unreasonable. Certainly we're not in the kind of, you know, the hundreds or the thousands that sometimes we find. So it looks to me like, you know, the employees are pretty well paid and the CEO is reasonably paid, but we have here a company which is in and I think it's fair to say severe financial difficulties and is struggling to trade its way out of the hole. So there you go. There's our analysis of McBride. I hope you found that informative and interesting. Please don't forget to like, share and subscribe the video, and I look forward to catching up with you on our next analysis. Hello, thank you for watching that video, and I hope you found its contents useful. If you want to know more about what we do here at Talk Financials, you can find out on talkfinancials.com, where we will explain how we design, develop and deliver training workshops for companies all over the world. We've worked with over 300 companies in over 35 countries around the world, helping them to understand financial statements, to understand business finance, and to become fluent in the language of business finance. If you're interested in developing your own skills in how you read and interpret financial statements, I've developed an online workshop which is available. All you got to do is click on the QR code there, point your camera at the QR code, and that will take you through to an online workshop, and it will help you to improve your own ability to read and interpret financial statements. I've also written a book called How to Talk Finance, and again, that is available. If you click on the QR code, it'll take you through to the Amazon website where you can buy the book either as a hard copy or as a Kindle edition. And that's really everything from me. I'm on LinkedIn. It'd be great to stay in touch. If you'd like to contact me, then again, just click on the QR code and send me a message. And good luck with your financial analysis. I hope it goes well.